Good morning, everyone. Welcome to the first of our midsummer series of events post Glastonbury. As the temperature climbs, it's time to start thinking what's next for investing. And this morning, I'm really pleased to say we have Marcus Fire-Mudge, the lead fund manager of TL Property since, I think, 2011. But Marcus's involvement with TL Property goes back to 1997, if memory serves correctly. TL Property is, I think it's safe to say, Europe's leading specialist investor in listed property shares, and provides investors with a unique way to invest in property, giving you the long-term correlation of commercial and some residential property, with a dynamic approach to moving in and out of different markets across pan-Europe. And the trust has a very long-term track record of increasing its dividend, which stacks up very well against inflation, something that not all REITs have been able to achieve over the last decade or two, which sets it apart. And indeed, TL Property's dividend yield is now approaching the level where it rivals many listed REITs. And Marcus and the team have also been leading voices in the last 2 or 3 years in the commentary and perhaps a bit more than just commentary on governance, during an era when M&A has been one of the big drivers of returns. And I'm sure Marcus will have a little bit more to say about what's been going on in M&A in his presentation. And so with that, I'll hand over to Marcus in one moment, but just as a small housekeeping, those who haven't attended one of these presentations before, there's a Q&A box in the bottom right-hand corner. You can type your questions. I'll be reading those whilst Marcus is presenting. It's only us that can see your questions, and I'll do my best to get through those after Marcus has run through his presentation, which should last about 20 minutes. So do please pop questions into that box, and let's make this as interactive as we can. So with that, Marcus, I'll hand over to you.
Alan, thank you very much, and good morning, everybody. And thank you all for being kind enough to sit indoors and listen to this on such a glorious summer's day as we're all having today. So I'm going to kind of talk for probably 25 minutes, and then I know that we'll plenty of time for questions on all topics around. Alan was nice enough to reference my experience on running TR Props. But I think it's much more important just to remind investors that the trust is the mothership, in as much as it's about $1 billion of assets, but we then run another kind of 1.2 billion in a range of other strategies, not only covering European real estate equities, but also global real estate equities as well. And it's very much a joint effort. It's not just me, as you can see on the bottom left-hand side, team of 12, 4 European languages, and lots and lots of experience in the team. A lot of team members who've worked with me for a long time. But just a little more on the trust itself. As Alan said, we are an investment trust, a FTSE 250 constituent, currently trading at about an 8 discount. So our net assets 1.2 and a market cap about 1.1, primarily in UK and European real estate equities, but we do have the ability to invest in physical real estate in the UK, generally up to about 15%. Formal maximum is 20, but generally 15 is our max. That is at almost at an all-time low, because we see so much opportunity in the equity market. And then we'll also talk about our gearing. We do have the ability to gear, and that is also at a record high. So we are, super optimistic about the market. But I should remind listeners that I'm not some perpetual bull about real estate equities. And if we look back at Q2 2008, so the quarter before Lehman's went down, we actually were holding 20% cash in the fund. So we can kind of swing between gearing of 20% and cash of 20%, and we're currently about 17% geared. So that's about as maximum as we can getting up to. Okay. And then I did just want to highlight the team. Sorry, the print's so small, but just, you know, a lot of faces, a lot of folk who'd worked with me for a long time. Deputy Fund Manager Alban Lonneur, he's been with me for 17 years. George Gay looks after our physical, 20 years. Joe Elliott, our Finance Director, 20 years. So, you know, a lot of people who've worked together for a long time. And the analysts are absolutely crucial. Part of what we do, Paul Gorry covering the UK and Scandinavia, and Aidan Bolton on Europe ex-Scandi. Okay, right, the trust itself, some of these points I've just covered, but just to sort of, this says currently gearing of 16.4, it actually crept up a little bit last week. Our year end is the end of March. So here are the numbers for March 25. That feels like a real age ago, because actually, you know, Q1 of our new financial year, so Q2 of the calendar year to the end of June, has been really quite, you know, much more dramatic. If I was to bring these figures, you know, up to the live number as at this morning, that Q1 of our financial year, so 31st of March to 30th of June, the figures would be 14.2, 13.6 and 17.1. Now, those are obviously very positive numbers. Our job is to beat the benchmark, which we always try and do, and we've managed to do 13 out of the last 14 years, so we're pleased with that. But the important number as well is that share price total return of 17.1, i.e. our discount has continued to narrow. So we've actually performed better than just pure NAV, and we'll come back to that a bit later. Alan referenced our dividend and our dividend profile, and our current yield is 4.8, 4.9%. You can see that the earnings profile has continued to steadily grow. Our average payout ratio is about 1x, but the board very much build the reserves in the years of plenty to help us pay out when income has been a little bit underwhelming. And of course, that has occurred initially post-COVID, but then during a period of very rapid rising interest rates, we've had companies who've ended up making less earnings because their cost of debt has gone up, and we've then had to use some of our reserves to utilize to ensure that we can continue to grow the dividend. And you'll see how for last year our dividend was higher than earnings. We still have earnings that equate to 6, 7, 8 pence. And we are pretty confident of being able to be a covered dividend player next year again, which will be great. We would be in the AIC dividend aristocrats comfortably if we had actually increased the dividend back in 09, 10, when we, as you can see from this chart, where we kept it level. But our 10-year compound growth rate of 8% is significantly ahead of many of those dividend aristocrats. So this really is an income. We have a very strong income component. But we do say that the TR, which originally stood for Touche Remnant, and then we became part of Thames River Capital. So then that was easy to say, we didn't need to change the name. And now Thames has been sold, or half of it sold to Columbia Threadneedle, our new brand. We now say the TR stands for total return, which is very much how we run the product, but very much with that eye to income. So a bit of sort of market backdrop. Why are we so optimistic about real estate today? What you could see on the left hand side of this chart is this is unlevered returns. So this is MSCI data, which it used to be called IPD for the older members of the audience. And you can just see how steady that in yellow, that income return has been, and then the volatility of capital returns. And you look at those negative periods, particularly in the early 90s when I started my career as a surveyor with quite a lot more hair. We had a very difficult period where there was essentially the consequence of the overdevelopment cycle of the late 80s. We basically built too much real estate, took a long time to absorb that vacancy, and rents fell to match that that sort of very low levels of demand at the time. And then, of course, the GFC, the other sort of disease for real estate is when the availability of capital, the availability of debt, particularly, or the price of debt, increases dramatically. And then more recently, a much shallower downturn driven not by the availability of debt, which was very much there. It was just the price of it moved very dramatically. But we now find ourselves in a really good looking, forward-looking outlook where the price of money is coming down, the long end of the curve is quite stable, but crucially, almost as a consequence of the GFC, we have very little overdevelopment. Remember, before the GFC, banks were big lenders of real estate. Remember RBS, Northern Rock, these guys, big lenders, speculative development. All of that has gone. The rules have changed. And when you look at the big, tower blocks built, it doesn't matter if you're talking about London or Paris or New York. These post the GFC, these have been funded by long-term providers of capital, sovereign wealth funds, well-capitalized listed property companies, pension funds, etc., not the banking community. And therefore, we've actually had a lot less supply, as it were. And that has been very much on the right-hand side manifested itself in rental growth. We've had these structural drivers, particularly towards industrial and logistics. We're all buying a lot more online. There's been obviously a huge wave of globalization that to some extent is reversing. And then you could see how office markets have office rents are very much plateaued. What we're now seeing is some very strong rental growth in the prime end, and we'll talk about that a bit later. And then, of course, retail rents, which obviously suffered a very, very sharp correction as we all moved online, particularly around the pandemic, and then have been now starting to grow very slowly, but only really at the prime end. Okay, and then when we turn to how does that look when you overlay the underlying market with what's going on in the listed space, and you can see really quite interestingly that we are still trading at these very wide discounts to asset value. We're a small sector when you come to look at real estate equities as part of the wider equity firmament. And there's a lot of capital that just said, look, I don't need to invest in that. Real estate does badly when interest rates are rising, and I haven't really seen the return profiles change, when in fact that's absolutely when things get incredibly cheap, and now is the time to buy into that. And that is probably one of the reasons why we're seeing so much M&A activity, because we're seeing private equity realize that the listed sector, the owners of the listed sector have sort of slightly lost interest, and yet the underlying fundamentals are improving really quite sharply. So that is really why I've been out on the road really for 6 months now, banging the drum and really trying to highlight the opportunity to investors. And then just to sort of add a bit more color to this point about M&A activity, these are, there's really two types of M&A. There's public to private, where literally private equity comes in and just bids for the listed companies, and particularly when they're caught trading at large discounts to asset value, then it looks very attractive when someone says, I'll pay you 20 to 25% more than the shares were trading at on Friday. You're going to be very tempted, even though the outlook may be quite attractive. And then on the left-hand side, what we have been encouraging as much as possible is consolidation. We do suffer in the listed sector of having too many small companies, and particularly when the natural owners of these small and mid caps, which are the sort of UK wealth management community, they themselves have they've enjoyed a huge amount of consolidation. If you think about Investec and Rathbones, Cas Capital being acquired by Schroders, Evelyn Partners, which is an amalgamation of Smith & Williamson, Tilney, Towery, and there are many, many more of these. And those managers, the last thing they really want to do is own 10, 15, 20% of a 300 million market cap property company. And therefore that amalgamation into larger companies is a good thing from a liquidity point of view, but it's also a very good thing from an earnings perspective, because you can, these small caps, you're removing one of, a whole lot of overhead function that's not needed. You need one board, not two. All of that regulatory oversight. Again, the cost of that is spread over many more assets, and we've been big beneficiaries of owning large amounts, not only of some of these companies that have been consolidated, but also owning a lot of the consolidators. And that, best example is London Metric, which acquired CT Property Trust, then LXI, and then more recently Urban Logistics REIT. Anything in bold on these two pages we had large positions in, and we really have a real opportunity in TR Props because we're a closed-ended permanent capital vehicle. I can really afford to take positions in some of these small caps, knowing that I'm not going to be required to liquidate those positions because somebody wants their money back, like an open-ended fund. And therefore I can work together with the board, with the management companies, and really try and work out what's the best way forward. And very happy to take questions on some of those live situations which you may have we have been quite vocal commentators on. So turning back to the portfolio itself, just to give you a snapshot, we don't put a lot of emphasis on the geographical spread. It's very much a bottom-up run portfolio, and the geography rarely dictates where we should be in a particular sub-market or not. But just as a consequence, you can see that the trust is more than 50% continental Europe. It's closer to 58. The UK, we're actually overweight relative to the benchmark. The benchmark is closer to sort of 32, 33 in the UK, and then our direct property exposure, which we've talked about. And then in terms of geography, just it's more sort of out of interest more than anything else. You can kind of see where we're particularly focused. We run the currency in line with the benchmark. So the best way to explain that is if Switzerland is about 12% of our benchmark, so we're slightly underweight Switzerland at the moment, which means that therefore our exposure to the Swiss franc is less than the benchmark. So we buy forwards to bring ourselves back up to that. So, and the reason for this is to sorry, so something just popped up as I was talking. The reason for that is the board want to make sure that my relative performance relative to the benchmark, I'm not enjoying any tailwind from currency exposure, nor do I wish to have that headwind. But you as an investor need to just appreciate that our exposure is very much a cross currency. Okay, now in terms of sector positioning, on the left hand side, these are our absolute weightings. Now, as you can see, these buckets, as we call them, because not all companies fit naturally into each one, some of them kind of overlap between two. What we're trying to do here is put each company into its own grouping in terms of where it's likely to be impacted by a similar series of macro forces. So you can see that London retail is different to the rest of UK retail. That's because London retail is all about tourism, both domestic and international. We need to separate UK retail from European shopping centres because both the construct of of shopping centres in Europe is very different to the UK. The UK shopping centres were anchored by department stores. They're a failed concept. There's been a lot of change in that area, whereas in continental Europe, they're anchored by hypermarkets, and they've been continued to enjoy all of that footfall growth, etc. And then the online exposure, of course, in the UK, we're at nearly 33% ex food and fuel. So, a third of all goods or more in some cases we're buying online. Meanwhile, if we jump over in our proverbial helicopter to say Italy, the figure is almost less than half that. So it's sort of 15-16%. So a very different outlook there. On the right-hand side, you can see our positioning relative to the benchmark. Now, this will always be a combination of not only sectors that we favour, and where our top-down is optimistic, but almost overwhelmingly, it's a function of bottom-up. So this is a function of, can we get companies, the right quality of company, with the right type of balance sheet and management team and structure, that we can get exposure to particular subsectors. And then, of course, it's a function of valuation. So to give you a good example, you'll see that student accommodation, we have a very small overweight to student accommodation. It's not that we are not that optimistic about student accommodation, which we think has legs, but it's because of the function of valuation of, we think that the stock that we're exposed to, Unite, is quite well priced at the moment. So we are happy to sit with a small overweight position, even though the fundamentals are very strong. At the bottom of the page, you can see Swiss diversified. We actually think things in Switzerland are fine. It's just, again, valuation is very strong. Meanwhile, in UK diversified, this is a function of actually, we're not that optimistic about some of these subsectors. It's about the pricing of those stocks. They just, to our mind, present a real opportunity, and potentially a real opportunity for further M&A, which again we can talk about, but happy to take questions in due course. Okay, now I thought we'd just talk a little bit about our largest positions, where we are relative to the benchmark. So this is our biggest overweights, and to run through some of these companies. Picton, a London metric, will be probably well known to you. Picton's a small cap. Stocks were trading for a long time at about 61p. They announced a buyback, which we were very supportive of. Shares have rallied up to 80, but you've still got an NAV of £1. Very well run company, internally managed. Run by a chap called Michael Morris, has just got a new chairman, Francis Solway, very experienced, had been back in the day, 2005, 2011, running chief executive of Land Securities, it was then, now Landsec. PAG is a German business, but it also has 25% of its assets in Poland, where we think is a very, very strong market, and we think is going to be a beneficiary of hopefully peace in Ukraine and further armament and general growth in economic outlook there, and help feeding off the recovery in the German economy as well. Argon is a French logistics business, 50% family owned. We like these sort of businesses where management have a lot of skin in the game. 100% let, owns about 100 different size of distribution units all over France. It's got a very strong capability of building basically net zero buildings using ground source heat pumps, solar panels, etc. Really, very interesting area. And then Phoenix Free Deutschland, this business owns flats in Berlin, which is a fantastic market. It's really recovering fast, and they're busy selling those flats to owner occupiers and doing well. And then on the short side, or the underweight as it were, Vonovia is almost countering TAG. There's a very big German residential name. We think its growth prospects are slower. Segro we can talk about, again, great business, but just its earnings growth is looking to moderate quite substantially in the coming couple of years. And then Castellum and Sagax are quite, we consider quite expensive stocks in Sweden. And then Merlin Properties, Spanish, done incredibly well, share price at an all-time high, thinking that's, we're sort of pulling back from that for the moment. And then position changes, don't necessarily need to run through all of these, but where you see the green arrow is where we've sort of added to names. And then where you have the red arrow is where we've reduced, which we've talked about much of this. You'll notice that German residential will have both a red and a green arrow. This has been because we've been through the tumultuous times of impact initially of Liberation Day and the tariffs. Then we had the fiscal bazooka from the German government, change of government, and bond yields, risk of bond yields rising as the economy is sort of reignited with central government funding, and now we're back to a situation where it appears to have stabilized as people realize that in fact it's going to take quite a long time for that transmission mechanism to move through in Germany to any risk of inflation, but actually it's just a very positive sentiment move which enabled us to add to that TAG position. You'll notice Assura, Warehouse REIT, Urban Logistics REIT, all of these are names that we've either had big positions in, something like Urban Logistics REIT, we were buying them for the first time in December and January at £1, and they ended up being taken out at, 104 was our initial price, taken out by London Metric at 156. So that's just one to call out. And then finally, briefly on the property portfolio before I hand over to Q&A, because we will have done 22 minutes. You'll see that we've added in the last year a couple of industrial buildings, industrial building in Northampton, then industrial estate at Bicester, which we're super excited about very much. Bicester is very much a beneficiary of that Oxford to Cambridge arc. And then at Wandsworth, sorry, we haven't got the actual slide on, but Wandsworth, this is a little industrial estate that I bought in 1999. The rents were £8 a foot, and over the years we've moved the rents up to about £25 a foot, and we're now doing a rolling refurbishment program of this estate. It's right next to Wandsworth Town Railway Station, for those of you who know that part of the world. Very nice pub called the Alma, quite popular with the property community in the Wandsworth area. It's opposite this estate. We're in a rolling refurbishment program, and we've just achieved £45 on 2 units and about to complete on a third, and are in talks on a fourth. And we've only actually refurbished 5 units so far. So we're very excited about that. And this is all about the loss of industrial space across big cities, because of course they're the lowest common denominator of value, a single story industrial building. Everything where you can put layers and layers on top of it, be it a tower block of offices or a tower block of residential, just about any other use is more valuable, which is why we've seen this huge reduction in the amount of what we call ultra urban industrial space, allowing us to move these rents, and tenants can afford it. So it's a really, really interesting, and that's going to be hopefully an ongoing, very profitable scheme for us. So just pulling things together, a few bullet points here. Interest rate trajectory positive. The short end of the curve is coming down. The longer end is looking pretty stable. Significant undersupply of prime space in many of our markets. We've seen record rents now being paid, not only in our ultra urban industrial rents, but also let's take prime offices in the West End of London. We have virtually no supply there, 3% vacancy. Retail warehousing is another class where, again, nationwide vacancy is 3 or 4%. Rents can only go one way. Valuation declines are slowing, if not stopped, and that's very important. In fact, we're seeing values climbing again. Equity prices remain heavily discounted. The point about this disconnect between what's going on in the underlying market and our equity market. More M&A. I'm afraid we've still got a little bit more. I think we are getting, I was asked the other day, are we very much in the second half? I think we're probably into the last sort of 15 minutes of this particular match. And there are only a few names to go. And then opportunistic capital raises on the rise. This is a good, healthy sign of capital being raised by these companies, which are, you know, collectively they're in good shape. We have an average LTV across our space of about 33%. You know, a lot of private property companies are very indebted with much higher levels of debt with that. And these listed companies have been very carefully managed, very conservative. They're now out there spending money and buying assets. So really, really useful, a real opportunity for them. And on that note, I think I'll just hand back to Alan while I just have a quick slug of water. Thank you, Alan.
Thanks, Marcus. I'm pleased to say this is the first of these events we've hosted this year with no questions about the US government, which is a relief. I'm going to start with quite an interesting, unusual question, which is around in the UK that the land registry is widely being reported as being very, very slow to register changes of ownership. And the question is around, does that create any issues with index data? And I think it might be worth just going a little bit into how, I know the IPD index or the MSCI index isn't TL Property's benchmark, but it's an important measure of property performance, isn't it? It might be worth just expanding a little bit on how it works, because it's different to other benchmarks, isn't it? It's a measure of active managers rather than passive achievement. And then it might be, don't worry if you forget the second half of this, but I'll come back to it. But perhaps useful to talk about how valuations work in the UK compared to the rest of Europe, because I think there's been an arc of asset allocation in TL property over the last few years that's reflected the different speed at which valuations are updated. So it might be worth going a little bit into that as well.
Thank you. And live Q&A is always very interesting because you just don't know what you're going to get asked, and therefore one has to very much think on one's feet. So thank you for that. Really a question I've never been asked before, but it is very, very worthy of discussion. So the MSCI data, which is essentially MSCI acquired IPD, and IPD was created 30 plus years ago because there was no benchmark for particularly institutional grade commercial property. And essentially the data is really available to anybody who's prepared to commit their numbers to the benchmark. So if you put your numbers in, like we do for not only TR Property Investment Trust, albeit we only have a couple of small number of buildings, but we also run another vehicle, which is a hybrid vehicle, which is roughly 70% equity, 30% physical. And there we value our physical real estate in that fund monthly. So we contribute that data into the MSCI monthly data bank, as do any other monthly valued fund. So you can go into the monthly, the quarterly, or the annual. And essentially, as Alan said, it's just all valuation information from active managers. So the points of reference are the independent valuations, be they monthly, quarterly, or annual. So it's not whether that information, let's say you bought a building and it hadn't yet completed its full registration at the land registry, because as you say, there has been a bit of a backlog, although things are increasing or speeding up rapidly. And the land registry are pretty good on commercial. It's much slower on residential, as you know. We're not talking about residential in this case. So, but actually the data points into MSCI are provided by us. It's not a function of whether that we've completed the registration process with the land registry. However, you are raising an important point, or there's an important point here, which is to some extent the MSCI data, the IP data, has been sort of degraded by the fact that they're quite rigid. So on the annual data, if you have a March year end, you can't submit data in if you have a for what is the annual index. So it may seem surprising to you, but Landsec and British Land do not put their data into the annual series because it is they have a March year end. So little things like that. So I think you have to be a little bit careful about the data, but to the extent that we have no other source, essentially, it is of course a useful indication, particularly of turning points. To come on to the second question about the valuation, how valuations are conducted. There are very much, and what's so fascinating is you could have very large international valuers like CBRE, Knight Frank, Jones Lang LaSalle, who will have valuers based in London who will value one way, and their equivalent in Germany or France or the Netherlands or Sweden will value differently. And what I mean by that is the valuation in valuers in the UK, very much our Red Book, RICS Red Book, is trying to utilize live market data, which of course is always backward looking. You know, you do a deal, by the time it gets into the valuer's sort of list of comparable evidence, that might be a couple of months later, but they are trying, and they're very aware that they are behind the curve. So particularly when markets are rising, they're probably undervaluing. When markets are falling, they're probably overvaluing. And that's where that's why the listed market tries to take account of that. Now, in continental Europe, this is going to sound very odd, but the model is different. They tend to mark to model rather than mark to market. What I mean by that is they run really sort of complex DCF calculations using particular discount rates that they kind of tweak up and down. So you tend to find that actually valuations in Europe will step across. So if there's a violent collapse in values like we had in 2008 in the UK, resulting in many listed companies worrying about breaching their debt, their LTV covenants, and they went and did a whole lot of emergency rights issues that really made only the partners of Cazenove rich, not many other people. But in continental Europe, they basically didn't really move their valuations. The banks were happy with that, and they kind of stepped across that correction. So what happens is you get the rule of thumb is you get much more accurate valuations in the UK, albeit lagged, but with that higher volatility compared to continental Europe, where they tend to smooth through the cycle. So as a result, we have a situation where we in Europe we often take NAVs with a pinch of salt. We're much more focused on earnings, on metrics such as net debt to EBITDA, because ultimately it's about cash flow. And remember that NAV is an art, not a science. I mean, it's no different for a £50 million tower block as for a £2 million house in the country somewhere, where you get your 3 estate agents to come along and value it for you. They're all going to come up with a different number. I mean, obviously they'll be inflated to try and win the business, but put that to one side. Ultimately, there could easily be a 10% spread in that. So and it's no different to commercial valuation. So we do have to remember that it's an art, not a science. And when markets are very much in a state of weakness, we have publicly had a slide on our presentations that says NAV, which technically stands for net asset value. We actually say equals not actual value. So it's very much a health warning to investors about, be careful with this. So don't go and buy a share just because it's trading on a very large discount to asset value. There may be a lot of reasons. And that doesn't mean there won't come a point where the market misprices that. Because what we find in the listed space, and I've now been running money since equity money since 1999, started Property Growth and Income 2004, took over from Chris Turner, my predecessor, running TR Props in 2011. So kind of got the t-shirt, been through a few cycles. What we tend to find that is as share prices fall and asset values also fall, the stock market's like, oh my God, I don't know when, I don't want to catch a falling knife. The NAV is still falling. So they tend to keep on driving the share price down long after actually the NAV has plateaued. And that's where we're using our market intelligence in the physical market. And whilst we only own a few physical assets in TR Props, we do have, you know, another 200 odd million pounds worth in a team of both George and Hannah. And George and Hannah, part of their job is to spend a lot of time looking at real-timed market evidence and being in that physical community and helping me find out when we have those turning points in the physical market while the equity market is still dropping pricing. So sorry, I tend to give long-winded answers to questions. I will get a bit quicker because I know we've got a few to get through. Back to you, Alan.
Inevitably, there are a number of questions on interest rates, and I'll try and roll those into a single question. But before we do that, there's a question about PR Properties dividend cover, and there's a series of events, isn't there, that means that dividends have been pushed back and brought forward and timing has changed, which means if you look on a financial year basis over the last few years, you've had some shortfalls. Do you want to talk through that? And I know that the board said that they expect dividend cover to be re-established in the foreseeable future. So it would be good to just sort of cover what's happened and how you see that returning to cover.
Yeah, absolutely. Great question. So when we look back at the last 15 years, whilst the payout ratio has averaged 1 times, there have been many years where we've had the payout ratios been at spot 9.2, spot 9.3, spot 9.4, as the board build up those reserves under our guidance, very much, you know, making it clear to them that we want to be able to pay a progressive dividend. We need to have those reserves. It's one of the great attributes of an investment trust structure that you can have those, you can store those revenue reserves, because the time will come where, for a variety of reasons, you know, your companies are delivering less income. And we had, you know, a right-left punch. You know, right was COVID, followed by left was rapidly rising interest rates. We had some companies that had either over-borrowed or were borrowed or had a lot of short-term debt. And it doesn't matter how quickly you get out of those exposures to that company, you know, everybody in some respects was impacted. And even now, we've got great businesses where they had really smart finance directors who fixed a lot of their debt in 2019, 2020, even into 2021. But of course, you know, no different to you or I having a 5-year fixed rate mortgage. At some point, you're going to roll off and have to refix, but you're not going to have that 1.2, 1.3, 1.4% interest cost that you had, you know, back in the day. So you've got, you know, a lot of, and we factor all of this in. We look very carefully at the cost of debt profile for all our companies. They may be growing their top line, but if their interest bill is going up, then their bottom line is going to be impacted, and that's something that we have to factor in. But at the same time, we are being very encouraged by, you know, the growth that we're seeing in dividends, even with that sort of headwind coming through some of these companies. And as a consequence, the board put out that statement, and, you know, essentially it means that whilst they can't say next year, I think the foreseeable future is to make sure that everyone knows that it's not long after that. But at the same time, it is of course a function of the positioning of the portfolio. Right now, we are a total return animal. I am at my maximum gearing because I see growth in capital terms. Now, that debt that I'm borrowing, the money I'm borrowing to enable to gear, that of course has a cost, and some of that cost flows through the income account, some of it flows to the capital account. But so we are always managing both of these factors. So shareholders should just take comfort from the fact that we do still have these substantial reserves, and that we are very much aware of what we need to do to build back to full cover. So and I'm hugely encouraged by the feedback that I'm getting from our underlying companies. And for example, some of them are doing opportunistic capital raising right now because they're making accretive acquisitions. We've got M&A that is accretive and moving earnings on. So yeah, I'm confident that we will be able to illustrate to shareholders, as we have done in the past, the benefits of this structure. But please bear in mind that TR, you should think of it as standing for total return. That's very much what we're trying to achieve here.
Yeah, and just coming back to interest rates, without trying to push you to give a forward-looking forecast of interest rates in different countries, it's widely discussed, isn't it? What are there any kind of pauses for thought that you have about interest rates and debt with listed companies, and I suppose that for example, on the one hand, German bonds are at a low level, but on the other hand, the German government is about to start borrowing a lot of money. And then another side question, which is quite interesting, is about the US dollar versus euro and sterling. Obviously, you referenced M&A, and a lot of the take privates have been from US private equity money. Does the change in the rate change their appetite for property? Does that give you a pause for thought?
Okay, it's a couple of great questions, and let's deal with them in reverse. Of course, absolutely, we've all noted the dollar weakness, and our conclusion is that most of this private equity capital, which is invariably the likes of Blackstone, Brookfield, Starwood, one or two others, is essentially the capital has been raised. It is ring fenced. It is sitting in Europe, not necessarily in the US. And I think these private equity houses who are buying these assets for a multi-year trade, that I think the currency is not a driver for them, and nor is it necessarily going to preclude them from an investment decision that has to stand on its own feet in local currency. Now, those returns might be magnified or weakened depending which way the currency goes. So, but we don't see it as it's never been used as a reason for a particular private equity bid being, for them pulling out or as far as we are aware, although obviously we're not as close as some people to that. In terms of interest rates, I think there is just a general acceptance, well, there is, that European economies, even including Germany, are continue to need the short end of the curve to come down. And please bear in mind, of course, when we sit, most of our investors are UK domiciled UK investors, and we almost have our own set of issues, particularly around what this government is doing in terms of risking the long end of the bond market with unfunded spending, etc. Particularly, a very live situation with the vote tomorrow, and the need to spend so much more money on defence. But when we look at Europe, for us, it's a lot of this is about the margin, and the fact is that borrowing in euros, we have plenty of examples of property companies either accessing the bond market or the euro bond market, or bilateral lending with their banking relationships, coming all in 5 and 7 year money inside of 4%. Now, that's a sort of magic number in some respects, given that a lot of the real estate these guys are owning is in the 6s, 7s of implied yields. Means that we're back into cash flow positive territory. Switzerland, of course, we've got inflation falling rapidly, and rates really heading back to close to zero, and that of course has supercharged our exposure through Swiss prime Swiss property and Swiss prime site, which is very confusing if you're dyslexic, PSP and SPS, which have enjoyed, and we've taken some profit in those, as you know. But for us, it's really as much about those margins condensing as much as we just want stability in the curve, but with margins condensing, which means that there's competition amongst lenders.
Yeah, that's great. Thanks, Marcus. I think predictably we have run slightly over time. I think we've covered the kind of main arc of questions, but what I would say to everybody is this is being recorded. You can download the slides. I can say with a high degree of confidence that Marcus puts more than 10 minutes work into his manager's report, which has just come out, and his monthly commentary. So you can find those on his website. And obviously Kepler also provides information on TR property and some of the REITs that Marcus invests in. So you can always visit our website too. Thanks for attending, everyone, especially with Wimbledon now on and the temperature rising even as we speak. And look forward to seeing you on the next one. And thanks, Marcus.
Thank you, Alan. Thank you, everybody. Goodbye.